Many people are wondering why the Federal Reserve is performing quantitative tightening so intensely, and what caused this high inflation which forced the Fed to raise interest rates. This is a very important video, and I hope this video will make everything clear. The Fed kept the interest rates too low for too long. The interest rates were at 0.25%. It was basically zero. Everybody was used to the low interest rates. Then the pandemic came and the GDP started to fall. Because of that, the Fed started printing money, which is nothing but quantitative easing. The Fed printed way too much money back in 2020, hence the stock market was able to rally in 2020. The Fed had to print back then because we had lockdowns, we had unemployment skyrocketing, and the GDP fell by 3.5%. The Fed had no choice but to inject trillions of dollars into the economy. When you print trillions of dollars and inject new money into the economy, that new money is going to inflate everything, including the stock market. That's what happened in 2020. The stock market skyrocketed because of money printing. We are facing high inflation. To lower inflation, what the Federal Reserve is trying to do is take the money back, which is nothing but quantitative tightening along with rising interest rates. Once the Federal Reserve started to take the money back, the stock market started going down. You might wonder how the high interest rate environment will reduce inflation. When interest rates are raised, it becomes more expensive for individuals and businesses to borrow money, which will make them less likely to take out loans, which can reduce the overall amount of money circulating in the economy. As a result, consumers and businesses are likely to reduce their spending. This reduction in spending can help reduce the money supply in the economy. A tighter money supply can lead to reduced spending and, in turn, lower demand-driven inflationary pressures. This can help to slow down economic activity and reduce demand, which in turn can lead to a decrease in inflationary pressures. Along with the high interest rates, the Fed started to perform quantitative tightening. This is very important, so please pay attention. None of the traditional media will report this information. So, back in early 2022, the Fed announced they were going to tighten by $47.5 billion per month for June, July, and August. But they only removed $47 billion for those 3 months. They failed to do so, because if they tightened like they said, they would have hurt the stock market, the housing market, just the economy in general. You can check out their website. Everyone has access to that website. We had the midterm elections last year, and hence the Fed didn't do the tightening like they wanted, as it might affect the midterm election results. So for political reasons, they tightened less than what they said they would. In September of 2022, the Fed announced they would need to ramp up the tightening, and they would remove up to $95 billion per month soon, and they would do so for 2 years. Ever since the Fed ramped up quantitative tightening, the stock market started going downwards. The S&P 500 was at 4,700s in 2021, and then it fell down to the 3,500s range by the last quarter of 2022. So here's another thing. You might be wondering why the Fed planned to remove $95 billion and why for 2 years. The money printing we did. The excessing money that the banks and financial institutions don't know what to do with the excess money. If you don't believe me, you can look at the Federal Reserve website. The banks and the financial institutions kept the excess cash at the Fed for a small interest rate. The banks and the financial institutions are doing this because they literally have nothing better to do with the money. This is what the reverse repo market is. Take a look at the reverse repo market back then when the Fed announced its tightening plan on the Federal Reserve website. Just look at how much money the banks and the financial institutions have parked at the Fed. It is $2.2 trillion. Look at the time of the start of the pandemic and look at 2020, 2021, and 2022. That's the time the Fed started to print trillions of dollars. As I said earlier, the Fed wants to remove money back for 2 years. Do you know why the Fed wants to remove $95 billion per month for 2 years? It's because $95 billion per month for 2 years equals $2.2 trillion. That is exactly the same amount of money that is sitting unused in the reverse repo market. The Fed tried to do a soft landing, but it failed, at least till now. The Fed prints money, the stocks go up, the Fed takes money, and the stock market goes down. You don't fight the Fed. I understand the stock market is not connected directly to the economy, but it is connected directly with the money printer. The problem lies not in the stock market, but in the debt market. Look at the 10-year yield. If the 10-year yield goes up, then basically we are screwed. As the interest rate rises, the Fed needs to pay more interest on the debt. They are no exception, and they have a budget. If the interest rates go up 2% or 3%, can the federal government withstand that for 1 year? Of course, yes, for a short amount of time. However, can they withstand for extended periods of time for like 3 years, 4 years, or 5 years? Absolutely not. This is what I am predicting. Sooner or later, the Fed is going to pivot. That's when the Fed will reduce the interest rates again and start the money printers back on, and this will skyrocket the stock market and crypto market. It's not just the stock market. The government tax revenue will go up because of this. The government loves this. It soared in 2020 and in 2021 because of capital gains. Even the state government collected a record amount of taxes due to capital gains. Just think about what happened to the tax revenue last year and this year. How's the stock market doing for last year and this year? If you don't make any money from the stock market, the government will not be able to collect taxes from your capital gains. The Fed needs money because of the high interest rates. They will get hit as well. For all reasons, financial and political Federal Reserve will start printing again. They will do so because they will have two options: either collapse the country or turn the money printers back on, which will cause inflation. The Fed will choose more inflation. They will have no choice. The Fed cannot survive the deflationary environment. That's because they cannot tax deflation. They need inflation to pay for the old debt. Therefore, the Fed will turn the money printers back on. When that happens, we are going to have more inflation, including the stock market. So when will the Fed turn the money printers back on? It might happen sometime in 2024. When the Fed starts printing money, they won't do it randomly. The Fed will announce it. You should pay attention to the monthly CPI, PCE reports, and FOMC meetings and form your own opinion. Also, you need to track the quantitative tightening. You can check this on the Federal Reserve website. You can see how much money they have been removing from the economy and how the market has been reacting. Also, the 10-year yield curve. The higher the yield, the stock market reacts poorly. Finally, pay attention to the reverse repo market. This is also on the Federal Reserve's website. That's all the data I am looking to predict. All these data are publicly available and free. Please take advantage of these data points. When the Fed starts to print money, it's going to happen in 4 stages, which is the Fed pivot. Stage 1, slowing down interest rate hikes. This process has already begun, with recent rate hikes ranging from 0.75% to 0.25%. Stage 2, pausing interest rate hikes. In this phase, the Federal Reserve will halt interest rate increases altogether. Stage 3, lowering interest rates. This phase involves the Federal Reserve starting to lower interest rates again. Stage 4, quantitative easing, involves the Federal Reserve resuming the process of injecting money into the economy. Currently, we are in stage 1 of the pivot, where the Federal Reserve is gradually slowing down interest rate hikes. Jerome Powell, during the most recent meeting, indicated that rate cuts are not expected to occur this year. The Fed will only proceed to stage 4 if there are significant economic issues. It's important to note that the stock market rally typically occurs after stage 4, not during it. Understanding the timing of each stage is crucial to maximizing gains. And with that rally, we are going to see a lot of new millionaires. So it's better to understand what's currently happening and enter at the exact point to get the maximum gains. This is called the lag effect. You can check the history of the previous recessions. If you want to know more about the Fed pivot, I have made a detailed video on Fed pivot, and you can check that video to know more. If there is a liquidity crisis in the debt market, the Fed will immediately restart the money printers back on directly, which is very unlikely because that will cause a huge financial crisis. I hope I have explained everything. Please subscribe. Thanks for watching. Until next time.